The headlines have moved on. Maduro is in New York, the airstrikes are over, the press conferences are done, but the real story is just beginning. Because what happened in Venezuela is part of something bigger. Greenland, the Panama Canal, Canada, Venezuela, these aren't separate conversations. They're connected by one strategic logic that most analysts are missing. This isn't about one man in handcuffs. It's about securing resources, controlling trade routes, and positioning for what comes next. The administration calls it national security. Others call it economic containment. But whatever you call it, the mechanics are the same. Control the supply lines, control the pricing systems, and deny competitors access. Today, I'm going to walk you through the economic logic behind what's unfolding across the Western Hemisphere. Not the politics, not the personalities, but the structural moves that are reshaping energy markets and global positioning. Three things matter right now: oil reserves and who controls them, currency flows and what system prices them, and China's expanding economic footprint in regions the United States considers strategic. Let me show you what's actually happening. South America as an economic battlefield. Here's what most coverage is missing. Venezuela didn't happen in isolation. It's one move in a continental economic contest that's been building for 2 decades. China-Latin America trade hit $518 billion in 2024. That's not a typo, over $500 billion, and it's growing at roughly 30% annually. 20 years ago, China accounted for less than 2% of Latin America's exports. Today, China is South America's largest trading partner. Brazil trades more with China than with the United States. So does Peru. So does Chile. Ecuador just signed a free trade agreement with Beijing in 2024. Nicaragua did the same. 22 out of 33 Latin American and Caribbean nations have joined China's Belt and Road Initiative. This isn't just trade statistics, this is infrastructure. China now owns or operates major ports in Peru, Brazil, Panama, and Ecuador. The port of Chancay in Peru, which just opened, is designed to handle exports from 6 South American countries directly to Asia, cutting the United States out of the supply chain entirely. So when you hear about Venezuela, understand the context. The United States is watching its historical sphere of influence shift economically toward Beijing. And that shift isn't abstract. It's ports, railroads, energy contracts, and payment systems. Secretary of State Marco Rubio's portfolio is Latin America. That's his focus. That's his expertise. And his strategic goal is clear: reassert American economic leverage in the hemisphere without full military occupation. Venezuela is the signal. It says if you move too far toward China, if you threaten dollar-based energy pricing, if you become a node in Beijing's supply chain, there are consequences. This isn't regime change in the traditional sense. This is market rebalancing through force. The oil denomination question. Now, let's talk about what this is really about. Not oil volume, oil denomination. Venezuela has the largest proven oil reserves on Earth, roughly 300 billion barrels. But production has collapsed. Under Maduro, output fell from over 3 million barrels per day to less than 1 million. Infrastructure decayed, investments stopped, skilled workers fled. So, if Venezuela isn't producing much oil, why does it matter strategically? Because it's not about current production, it's about future control. Here's the mechanics. For 50 years, global oil has been priced in US dollars. This system, called the petrodollar, creates automatic demand for American currency. Every country that needs oil needs dollars to buy it. That demand allows the United States to borrow cheaply, print money without immediate inflation consequences, and finance its debt at lower interest rates than economic fundamentals would otherwise allow. But that system is fracturing. Saudi Arabia refused to renew its exclusive dollar agreement. BRICS nations, Brazil, Russia, India, China, South Africa, are increasingly settling energy trades in local currencies or yuan. And Venezuela, according to multiple reports, was preparing to fully integrate its energy sector into China's cross-border interbank payment system and price its oil in a basket of currencies led by the yuan. If that had happened, China could buy Venezuelan oil without holding dollars. If China doesn't need to hold dollars, demand for US currency drops. If demand drops, the dollar's value falls. If the dollar falls, the cost of servicing American debt skyrockets. This is the threat. Not that Venezuela would sell 1 million barrels a day to China, but that Venezuela, sitting on 300 billion barrels, would prove you can price oil outside the dollar system and survive. That's the precedent Washington couldn't allow. So they removed the government. Trump said it explicitly at his press conference. He said US oil companies would go in, rebuild the infrastructure, and extract wealth. He said the oil would go to other countries and to the United States as, quote, reimbursement for damages. Rubio walked it back the next day, said the US doesn't need Venezuelan oil, said this is about governments, not resources. But the contradiction tells you everything. Trump says what the operation is about. Rubio manages the diplomatic fallout. The reality is somewhere in between. The United States doesn't need Venezuelan oil today, but it needs control over that oil. It needs to ensure those reserves stay denominated in dollars. It needs to prevent China from securing an independent energy supply outside the American financial system. This wasn't about liberating Venezuela. This was about locking it back into the dollar framework, positioning for what comes next. Now, here's the layer most analysts are ignoring. This isn't just about today's oil market. This is about pre-war positioning. I'm not saying war with China is imminent. I'm saying the United States is consolidating its hemisphere in case that conflict comes. Look at the pattern. Pressure on Canada over trade, rhetoric about Greenland and its mineral resources, renewed focus on the Panama Canal and who controls shipping lanes, and now direct intervention in Venezuela. These moves share a common logic: secure the backyard, control critical supply lines, deny adversaries access to resources and infrastructure in the Western Hemisphere. Before you fight a peer power, you secure your rear. You make sure your energy is reliable, your trade routes are protected, and your neighbors aren't providing strategic depth to your opponent. Venezuela fits that calculus. It's not about fighting Maduro. It's about ensuring that if tensions with China escalate, South America's largest oil reserves don't become a Chinese energy lifeline. This is strategic husbandry, securing resources, locking in contracts, controlling insurance and shipping frameworks before they're needed in a crisis. The domestic political framing is different. Of course, the administration talks about the Monroe Doctrine, about national security, about defending the hemisphere. That language resonates with American voters. It sounds decisive, strong, protective, but the underlying strategy is economic containment, preventing China from securing independent access to critical resources and using military force to enforce that containment when economic pressure fails. What happens to prices and markets? So what does this mean for actual markets, for oil prices, for gasoline at the pump? In the short term, not much. Venezuela's current production is so low, less than 1 million barrels per day, that removing it from global supply doesn't move prices. OPEC has spare capacity. US shale can ramp up. The market absorbs the disruption. But markets don't just react to current supply, they react to expectations. And the expectation here is that US oil companies will eventually go into Venezuela, rebuild the infrastructure, and bring production back online. If that happens, if Venezuela's output returns to 3 million barrels per day over the next decade, that's significant additional supply. Heavy crude compatible with Gulf Coast refineries, priced in dollars. Energy stocks have already started pricing in that scenario. Expectations of contract resets, sanctions easing for select operators, preferential access for American firms. But here's the risk. Rebuilding Venezuelan oil infrastructure will take years and tens of billions of dollars, and it requires political stability. So, if Venezuela descends into internal conflict, if the transition government lacks legitimacy, If resistance movements disrupt operations, none of that investment happens. So markets are betting on a best-case scenario: smooth transition, cooperative government, rapid infrastructure rebuilding. That's optimistic for consumers. Gasoline prices won't drop immediately. Retail prices lag crude markets by weeks or months, and regional impacts vary. Gulf Coast refineries benefit first, other regions see smaller effects. The psychological impact might be bigger than the economic one. The perception of energy security, of American control over supply, of reduced dependence on Middle Eastern oil. That perception shapes policy debates and voter sentiment, even if the actual price change is minimal. Europe and financial pressure. Now, let's talk about Europe's role, because while military action happened in Venezuela, financial pressure is happening in European capitals. European governments have frozen Venezuelan government assets. Banks have been told to scrutinize transactions. Insurers are reviewing coverage for Venezuelan-linked shipping. This creates choke points that go beyond the military operation. If you can't insure a tanker, you can't move oil. If you can't clear payments through European banks, you can't settle contracts. If your assets are frozen in London or Frankfurt, you lose liquidity. This is how modern economic warfare works. The United States provides the military pressure. Europe provides the financial isolation. Together, they create a system where resistance becomes economically unsustainable. For Venezuelan elites, this is a crisis. Their wealth is tied up in foreign accounts, real estate in Miami and Madrid, investments in international markets. If those assets are frozen or seized, their ability to operate politically collapses. This gives the United States negotiation leverage, not just with Maduro's inner circle, but with whoever might assume power. The message is clear: cooperate and your assets are safe. Resist and you're financially isolated. The end game? Nobody's answering. So here's the question that should be dominating analysis, but isn't. Who actually governs Venezuela? Now, Trump said the US would, quote, run the country. Rubio said no, existing structures will handle day-to-day governance. Vice President Delcy Rodriguez appeared on state TV, claiming she's still in charge. Opposition leader Maria Corina Machado says Edmundo Gonzalez should assume the presidency. There's no clarity, and that's a problem because governance isn't speeches, it's enforcement. It's who signs contracts, who collects revenue, who controls security forces, who guarantees legal frameworks for investment. Right now, nobody has clear answers, and that uncertainty freezes everything. Oil companies won't invest billions without knowing who they're negotiating with. International banks won't clear payments without legal clarity. Shipping firms won't move cargo without insurance guarantees. So you have three possible paths forward. Path 1, controlled transition. The US brokers a deal with remnants of the existing government and the opposition. A transitional authority is established. Oil contracts are renegotiated. Revenue flows are restructured. This is the best-case scenario. It requires cooperation from multiple factions and years of institution building. Path 2, fragmentation. The government fractures. Regional power centers emerge. Some areas controlled by military units loyal to the old regime, others by opposition groups, others by criminal networks that fill the vacuum. Oil production stays disrupted, investment doesn't happen, the humanitarian crisis worsens. This is the Iraq-Libya scenario. Path 3, economic counterpressure. China doesn't accept the outcome. Beijing continues buying oil through shadow tankers, provides financial support to resistance elements, uses its leverage in other Latin American countries to isolate US-backed structures, turns Venezuela into a long-term economic battleground. This is the great power competition scenario. None of these paths are clean, none of them resolve quickly, and the Trump administration hasn't articulated which one they're pursuing or how they plan to navigate the complexity. This is high-stakes economic maneuvering without a clear endgame, and that's dangerous. What this means moving forward. Let me bring this back to what matters for understanding the bigger picture. The Venezuela operation wasn't about Maduro. It was about control over energy resources, maintaining dollar-based pricing systems, and countering China's economic expansion in the Western Hemisphere. Greenland, Panama, Canada, Venezuela, they're all connected. They're all part of a strategic consolidation of the hemisphere's resources and trade routes. The administration calls this national security. Critics call it overreach. But the economic logic is consistent. Secure supply lines, control pricing mechanisms, deny competitors access. Whether this strategy succeeds depends on variables nobody can predict. Can Venezuela be stabilized? Will oil companies invest? How will China respond? Can the US maintain legitimacy in the region while using military force? Markets are pricing in the optimistic scenario that Venezuelan oil comes back online, priced in dollars, flowing to American refineries and allied nations. But history suggests caution. Iraq was supposed to be quick. Libya was supposed to stabilize. Afghanistan was supposed to transition smoothly. Removing governments is easy. Building functioning states is extraordinarily difficult. And the question nobody in Washington seems to be asking is what happens if this doesn't work? What happens if Venezuela fragments, if oil production stays disrupted, if China doubles down on alternative supply chains, if other Latin American nations decide the risk of working with the United States is too high? Those are the questions that will determine whether this operation was a strategic success or an expensive mistake. And right now, we're too early in the process to know. What we can say is this: the economic contest for South America is no longer background noise, it's front and center, and the stakes are oil dollars and global positioning. That's the story. Not the arrest, not the press conference, the reshaping of economic power in the Western Hemisphere.